Okay, so, we've got some pretty interesting stuff to look at today.
Yeah.
You sent over a bunch of analysis and reports looking at the economic outlook for the U.S. for the rest of 2025.
Right.
And, like, the big question on everyone's mind, is are we heading for a recession?
Yeah. The big R word, right?
Exactly.
It's on everyone's mind.
Yeah, so we're going to take a deep dive today. You gave us this
Hmm.
analysis Prospectivo document, which seems to be like a
Yeah.
pretty in-depth, forward-looking analysis.
It's a really comprehensive report.
Yeah, and then we've got perspectives from some of the major financial institutions.
Exactly. Yeah. We've got Goldman Sachs. We've got
Yeah.
JP Morgan, a couple others.
Right. So let's try to break this down.
Yep.
What are the key takeaways here?
Absolutely. I think, the big takeaway just from kind of scanning all of this is there's a growing sense of uncertainty about where the U.S. economy is headed. And I think this analysis perspectivo document really captures that right in the title. Growing uncertainty.
Mm-hmm.
So think about it. We're in early 2025. And already there are these warning signs that things might be shifting
Right.
in a not so good direction.
Okay, so let's jump right in then.
Yeah.
We were looking at what some of the big, financial institutions are saying.
Yeah.
And Goldman Sachs, for example, they've upped their probability of a recession happening from 15 to 25%.
Right.
And they seem to be pointing the finger primarily at all the uncertainty around trade policy.
That seems to be their biggest concern.
Yeah, but what's interesting is that they still describe the risk as moderate.
Right.
So despite these challenges, they're not, hitting the panic button just yet.
So maybe they're seeing some strengths in other areas of the economy that could, sort of offset the trade issues.
That's a good point, yeah.
Yeah.
Maybe they're seeing positive trends in consumer spending or specific sectors that are still performing well.
Right. Or maybe, the trade stuff is just so unpredictable they don't.
Yeah, exactly. Want to go too far out on a limb.
You can't really model that kind of uncertainty.
But then you have, JP Morgan.
Yeah.
They're being a lot more cautious.
They are, yeah.
They're saying there's a 45% chance of a recession hitting by the end of the year.
That's a pretty big difference in their assessments.
It is, yeah. And I wonder what's driving that.
Yeah.
Are they more concerned about, this sort of snowball effect where trade tensions lead to inflation, which then hurts consumer demand?
I think that's a very plausible explanation. They might be taking a more holistic view of how these different negative factors could interact and amplify each other over time.
Right, because it's not just, one thing in isolation. It's all of these things happening
Exactly. It's a complex system.
at the same time.
And JP Morgan might also just be inherently more risk averse in their outlooks, which would explain the discrepancy.
Right.
It's always good to consider the biases of these institutions.
And it's not just the big investment banks that are worried.
Yeah,
right?
not at all.
This analysis Prospectivo document mentions a survey of CFOs,
Oh, wow.
and a whopping 58% of them are saying they expect a recession in the second half of the year.
Yeah, that's a pretty clear sign that there's real concern at the corporate level.
Right, and these are the people who are, making decisions about spending and hiring.
Exactly. They're on the front lines, so to speak. They're seeing how these macroeconomic shifts are affecting their businesses in real time.
Right, and what are they saying is the, biggest worry?
Well, they're primarily worried about inflation
Okay.
and its impact on both consumer spending and business investment.
Because?
So, if consumers are feeling squeezed by rising prices, they're going to cut back on their spending.
Right.
And if businesses are seeing their costs go up and their demand go down,
Yeah.
they're going to be less likely to invest in new projects or hire new employees.
So it seems like this whole trade policy situation is really kind of at the heart of a lot of this anxiety.
It definitely seems to be a major factor. The U.S. government has implemented this minimum 10% tariff on imports.
Right.
And there's even talk of, potential adjustments in the future, which just adds to the uncertainty.
Yeah, the analysis Prospectivo document really emphasizes that unpredictability.
Yeah. And, it's causing a lot of friction with major trading partners.
Right, China, the European Union.
Exactly. And it's not just about the immediate increase in the cost of goods.
Right.
It's also about the uncertainty that it creates for businesses. When companies can't predict what their costs are going to be or how easy it's going to be to access foreign markets,
Yeah.
they're going to be hesitant to make long-term investments.
And we're already seeing the consequences, right?
We are.
This is leading to increased trade tensions. It's causing volatility in the financial markets.
Right.
It's disrupting supply chains.
Right.
And ultimately, it's driving up prices for consumers.
Exactly. It's like a domino effect. One thing leads to another, and it all kind of spirals downwards.
Yeah. So let's talk about some of the hard data here.
Okay.
The key macroeconomic indicators.
Sure.
GDP growth projections for 2025, they've been revised downwards.
They have.
S&P Global is now estimating just 1.6% growth, which is pretty anemic.
That's significantly below what we'd normally expect to see in a healthy economy.
Right. And then, there's this economist, Carl Weinberg,
Oh, right.
who's predicting a potential 4.5% contraction in the second quarter.
That's a pretty dire prediction.
It is, yeah. So, I don't want to be too alarmist, but
it does highlight the downside risks.
Right.
The situation is definitely fragile.
yeah, so 4.5% contraction in a single quarter, that's not a minor blip. That's a real...
That's a serious drop.
Yeah. Okay, so what about the labor market?
Yeah, the labor market is interesting because it's giving off some mixed signals right now.
Okay.
So the analysis Prospective document points out that formal employment is still relatively stable in certain sectors. But we're also seeing an uptick in layoff announcements.
Yeah.
And a slowdown in the creation of new jobs.
Right. Which makes sense if companies are worried about the future.
Exactly. The labor market often lags behind other economic indicators. So even though employment numbers might look okay right now, the fact that businesses are starting to announce layoffs suggests that they're anticipating weaker demand down the road.
Right. And that slowdown in new job creation.
Yeah.
That just kind of reinforces that sense of caution.
Absolutely. Businesses are becoming more reluctant to expand their workforce because they're just not sure what the future holds.
Right. And then, of course, we have the financial markets.
Yeah.
The S&P 500 has fallen by more than 10%.
Which is not a good sign.
Not a good sign. No, investors are clearly feeling uneasy.
They are. And, a market downturn like that reflects a heightened level of risk aversion.
Mm-hmm.
Investors are reacting to all of the negative economic signals we've been talking about. And that volatility in the financial markets can then spill over into the real economy.
Right, because if investors are pulling back,
Yeah.
businesses are less likely to invest.
Exactly.
And then consumers might start to get nervous, too.
It's all interconnected.
And then on top of all of that, we have inflation,
Yeah.
which just doesn't seem to be letting up.
No, it's really becoming a persistent problem.
And again, it seems like those tariffs are at least partly to blame.
They definitely seem to be playing a role. The idea was that tariffs would help protect domestic industries. But the unintended consequence is that they've also driven up costs for businesses that rely on imported materials.
Right.
So those businesses then have to either absorb those higher costs, which hurts their profits,
Yeah.
or they pass those costs on to consumers in the form of higher prices.
Which is what seems to be happening.
Which is exactly what we're seeing.
So if we kind of zoom out and look at the big picture,
Yeah.
I mean, it's pretty clear that the U.S. economy is in a very vulnerable position right now.
Yeah.
It is, yeah. I mean, we haven't officially hit a recession yet,
Right.
but all of the signs are pointing in that direction.
Right. The analysis Prospectivo document
Mm-hmm.
uses the term
Yeah.
highly vulnerable.
Yeah. And it's easy to see why.
Yeah, we've got slow GDP growth.
Yeah.
We've got trade disputes. We've got a shaky financial market.
Right.
We've got persistent inflation.
Uh-huh.
We've got declining business confidence.
It's not a pretty picture.
It's not. And the general consensus among the analysts seems to be that,
Yeah.
Without some kind of course correction,
Uh-huh.
this could easily turn into a prolonged period of stagnation or even contraction.
Exactly. And I think what they're most worried about is how all of these different weaknesses could feed into each other.
Right.
Trade tensions could exacerbate inflation. Inflation could dampen consumer spending.
Yeah.
Consumer spending could lead to lower GDP growth.
And then you get this kind of downward spiral.
Right. And that's why it's so important to be thinking about potential corrective measures.
Right. So what can be done?
Well, the Analysis Prospectivo document outlines a few key recommendations.
Right.
First, they suggest a more proactive monetary policy from the Federal Reserve,
Right.
which could involve lowering interest rates to try to stimulate borrowing and spending.
Yeah.
But of course, they have to be very careful not to overstimulate the economy and trigger even more inflation.
Right. It's a delicate balancing act.
It really is.
Then there's the recommendation to reevaluate the current tariff policies
Yes.
and potentially, ease up on some of those tariffs to try to de-escalate the trade wars.
Right.
Because that seems to be one of the biggest sources of uncertainty right now.
Absolutely. Removing some of those tariffs could have a really positive impact on business confidence.
And it could also help to bring down prices.
Exactly.
Okay, what else?
Well, they also suggest encouraging more domestic investment,
Okay.
particularly in strategic sectors that are key to future growth.
Right, so things like, technology and innovation.
Exactly. Investing in those areas could help to boost productivity and create new industries.
Right, and that would obviously be a long-term solution.
Yeah, it's a long-term strategy, but it's a really important one.
Okay, and then there's the less glamorous but equally important stuff like,
Yeah.
monitoring the data, having early warning systems in place
Right.
so that policymakers can respond quickly if things start to go south.
Absolutely. You have to have your finger on the pulse of the economy to be able to make informed decisions.
And then finally, there's the importance of communication.
Yes.
Making sure that the government is being clear and transparent with businesses and consumers.
Right, because in times of uncertainty, people need to know what's going on.
Right.
And they need to feel like someone's in control.
Okay, so to wrap things up,
Yeah.
I mean, we've covered a lot of ground here.
We have.
But I think the main takeaway is that the U.S. economy is facing a very real threat of recession in 2025.
I think that's a fair assessment.
It's not a foregone conclusion,
No,
but there are a lot of warning signs.
there are.
And it's going to require some very careful and proactive policymaking to avoid a negative outcome.
I completely agree.
And, as we've been talking about this,
Yeah.
it's made me think about, what are the key things that we should all be watching to really understand, how this is all going to play out.
All right.
Because it's such a complex system
It is.
with so many interconnected parts.
Yeah. What happens with trade policy affects inflation. What happens with inflation affects consumer spending.
Right.
What happens with consumer spending affects GDP growth.
All tied together.
It's all part of the same web.
So I guess I'd like to leave our listeners with this thought
Okay.
as we move through the rest of 2025.
Yeah.
What are the specific indicators that you're going to be watching to get a sense of, whether we're heading for a recession or whether we're going to be able to avoid it?
That's a great question for our listeners to ponder.
Yeah, because there's no easy answer.
There isn't.
It's going to require, really paying attention to the data and understanding how all of these different pieces fit together.
Absolutely. And I think it's going to be fascinating to see how it all unfolds.
Yeah, me too.